Hi, it's Lee and welcome to the Tesla Economist. If Tesla have to lower prices due to meeting demand, whether it's due to extra supply, worsening economic factors, more competition, or whatever it may be, then I thought we could take a look at how much lowering prices would affect Tesla's financials. And we could take a cross-section of how the company's finances may look in a situation. In Q1, we saw a discrepancy of 6% between production numbers and delivery numbers. Of course, this is production numbers around 440,000. We're expecting Tesla to be closer to 500,000 by the end of the year, which is more like a 19% increase in deliveries required to meet that number. That number would put Texas and Berlin at around 6 or 7,000 units a week. Okay, sure, still only about half of their actual capacities, but the numbers are at least getting a lot higher that the gross profit margins are far from cash furnaces. In fact, the ramping we've seen lately from these two factories should hopefully help margins somewhat now we have these lowered prices. So how much lower would Tesla have to drop prices in order to increase demand a further 16%? In all fairness, we are comparing the least popular quarter for auto sales of the year, which isn't the most fair, so maybe an annualized average, perhaps Tesla need to increase demand a further 10% still. We'll see the new refreshes soon of the Model 3 and Y. They may be so compelling that current owners may want to upgrade, especially as they'll have the new Hardware 4 features. How about we have a look at what earnings might be adjusted to if Tesla have to lower their prices to meet demand for 500,000 vehicles a quarter? Now we can do this a really simple way. Rather than estimating all the different models from all the factories, we can just take two numbers, ASP and gross margin. We have been told to expect an ASP above 47,000 and margins still above 20% according to Elon on the last earnings call. Let's do a 5% price cut and reduce ASPs to $44,500. If we previously had 20% margin on $47,000, then that would mean the cost per vehicle was $37,600. If the new price is $44,500, then we now have $6,900 gross profit per vehicle, compared to previously $9,400 over a 25% drop in gross profit, taking gross margin down to just 15.5%. Ouch, that does feel a bit low for Tesla. However, costs have come down a bit, and Texas and Berlin ramping more also has an impact, so I'm going to round this up to 16%. Now, over time, we should of course expect costs to come down and the margin to return to closer to 20%, and then increase further, hopefully, with the new models that Tesla launch. Cybertruck will likely have a very high profit margin. Tesla and the whole world are working on the EV supply chain and getting costs down, and no one is doing more work on that than Tesla. Alright, so let's run the numbers. For when Tesla are at around 500,000 deliveries for a quarter with a 5% price drop, we have ASPs of 44,500 and margins of 16%. It generates a gross auto profit of $3.56 billion. Compared to what we expect for Q1, it's around $3.95 billion, a difference of $400 million. Tesla selling 80,000 more units, but generate $400 million less profit. Tesla would be more profitable to reduce supply, but Elon says that is not Tesla's mission and seems determined on just increasing production, presumably because they'll all eventually serve as highly profitable autonomous vehicles, and also just to gain market share. We're going to try and do these financials as realistic as possible, so I've added in the subsidies that Tesla received too, and I had to estimate what Tesla's battery production would be at this stage they hit around this production level. The same with Megapacks, we would have expected some additional ramping to have occurred there. When we add in everything else, we end up with an earnings of $3.4 billion, which would be around $14 billion annualized, or a P/E ratio of about 40 at today's stock price. Now, in my opinion, these prices are probably lower than they should be due to being in such uncertain economic times. It's very easy for consumers to cut back on expenses by not buying a brand new car. And if things get worse, then according to Elon, Tesla are not willing to slow down production and will instead keep lowering prices to meet demand in order to build market share and to continually refine the manufacturing process. The economies of scale of increasing production will lower the cost of these vehicles continually, but those cost savings are likely not enough to lower the prices enough to meet the demand in this economy. As 4680 cells increase in production, that should help lower the cost of the cells and thus the vehicle somewhat. However, in the new Master Plan Part 3 white paper, we were shown that mid-sized vehicles like the Model 3 and Y would have an average of 75 kilowatt-hour batteries using LFP cells. Now, this table is for all electric cars, not just Teslas, and meant to be indicative, but it might be an indication that perhaps Tesla are eventually planning on moving over to LFP cells for 3 and Y. I have this theory that Tesla are done showing the world how amazing they are at making the best cars and how amazing electric cars can be. They've already proven themselves now, and it's not about being the best, but about being affordable. So they may very well move over to LFP cells, or perhaps CATL's N3P cells. They will still have a long range and performance version with 2170 cells, but it's likely that around 280 miles of range is still sufficient for the US market for the Model Y, and is still competitive compared to most of the alternatives, and especially when it comes to price. The CATL Chilean battery is structural too, so they could produce these LFP vehicles in Texas and Berlin and have front and rear castings, which could add further to the cost savings. Tesla just need to get their costs down and can sacrifice some areas of the car in order to do so. A car that is $5,000 lower cost will have more demand than one with 30 miles extra range. Then what will the 4680 cells be used for, or high nickel cathode cells as they refer to in Master Plan 3? Well, they'll be used for heavier vehicles like vans, trucks, SUVs and semi-trucks. I assume also 2170 cells. Anyway, back to the financials. This model assumes about a $2,500 drop in price for all models. That amount does certainly have an effect on demand. With Tesla ramped up to around 500,000 units a quarter then, there will be more economies of scale too. Moving from nickel cathodes to LFP in the cells would probably save that much money alone. More efficient manufacturing, cost reduction, parts and processes removal would make even more difference. We're seeing how fewer hours of labour it is taking to build cars in China and Fremont already, with more efficient manufacturing. Berlin and Texas still have a long way to go to meet their full potential. It just seems to be taking a long time. Those two factories may produce this 75 kilowatt-hour LFP Model Y with around 280 miles of range. I would hope that when those facilities are ramped up, then the cost must be around $35,000 per unit. And if they're selling them for $45,000, then there's still $10,000 profit per vehicle. I like to use $10,000 profit per vehicle as my target for Tesla, even for the compact. That would be around a 22% margin, and I think Tesla should try and eventually aim for 20% for all Model 3 and Y on average. If Tesla were able to achieve a 20% margin with 500,000 deliveries and 44,500 ASP, then that would take earnings from $3.4 billion to over $4.2 billion. Now that is a significant increase and would give Tesla a P ratio of 34 scaled annually relatively to that, which is probably a little low for Tesla, what with the Cybertruck probably out around the same time, and the Gen 3 factory making progress. And you know what, everyone? This is still really early days. These costs will come down more over time. Also, I think the prices will eventually increase again too when the economic environment becomes more stable. We also hope that progress with FSD will further increase demand and FSD adoption, resulting in more profit per vehicle, as an FSD subscription is pure gross profit. We're only talking about an annual run rate here of 2 million vehicles a year, 1/10 of Tesla's target. We have so much more growth to expect. Mexico with 1 or 2 million more cars, and potentially another factory to be built at the same time. We'll also see the energy business ramping up more too, and contributing more to profits. Therefore, if Tesla do need to lower prices during these times, then they can still remain profitable. And if things get worse, and they have to lower prices even more, and even make a loss if necessary, then as we like to remind ourselves, they are sitting on a lot of cash available too, to carry them through any serious economic downturn, which will simply make it harder for the competition. It does look like Tesla are close though, to matching supply and demand for the Model 3 and Y with a 20% margin. Tesla are working around the clock to get these costs down, along with the rest of the world sorting out the new supply chains for EVs. Eventually these costs will come down enough. And Teslas at those price points will be seriously competitive. It's really going to help though when we get the Q1 earnings report to try and establish a better idea of margins and ASPs. The Model 3 and Y will serve as the base of Tesla's electric vehicle business, the models that were essential in wakening up the supply chains. From here, Tesla can build on this foundation with improved manufacturing techniques, producing products in higher quantity with lower cost and more demand. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.